How's it going, everyone? My name is Amos, and in this video, we're going to be evaluating and ranking every single Nasdaq-100 income ETF against one another. That way we can truly see which one is the best and which ones are not so good. Because if you only look at them individually, they might look good on paper, but when you stack them up against each other, then you can truly see who shines like a hidden gem or like a beautiful person. And before I get someone commenting, why don't we have this represented? Dude, we're not gonna have any of those income ETFs that generate like 100 or 150% dividend yield in a single year, because they deserve a video of their own. This one is only gonna be the Nasdaq-100 income ETFs. So without further ado, let's go ahead and get into it. So first and foremost, let's lay down the foundation, the rules and regulations. You don't necessarily buy into an income ETF for the growth, right? You don't care about it growing in capital. You just want that stable, reliable, and steady cash flow, that passive income. That way you can calculate how much you need to invest to have all of your bills and living expenses paid for. So I think using the CAGR is kind of misleading and disingenuous. So instead, we're going to be evaluating these passive income ETFs by the following metrics that I thought were the most fair. Number one is going to be the stability of the share price, aka the capital preservation. Because what good is it to invest into an income ETF for about $20 a share, only for it to turn into $7 a share a year down the road? In my opinion, I think that's a rough situation, and I wouldn't be a happy camper. The second metric is going to be the history of the dividend payouts. Is it stable? Is it shrinking? Is it reliable? Do they pay every single month or week like they say they will? The third metric is going to be whether or not the dividends are treated as a return of capital versus ordinary dividends. Me personally, I prefer ROC, because not only does it lower your cost basis, but if you reach the end game of having your cost basis reach zero from those ROC distributions, your super high dividends will be taxed at the capital gains rate. So kind of like a qualified dividend payment instead of the ordinary dividend bracket level, which would be high. For most of us watching this, it's going to be like 22, 24, or even like 30%. And then the fourth metric is going to be the assets under management, the AUM. I think this is a very important criteria and metric that most investors overlook and they just ignore. Because the AUM tells us how much money investors have put into that ETF, which means if it's small and tiny, then the risk of it going belly up and disappearing and being delisted is much higher than an ETF that has an AUM of like billions of dollars. Does that make sense? So in the context of income ETFs, the bigger the AUM, the better it is. Not always, but better in that it's going to be more stable, and the risk of them disappearing because there's too little money invested into it is lower. And by the way, if you're not tracking, this is part 2 in a 2-part series. Which means if you haven't already, you should watch part 1 because we covered the S&P 500 income ETFs. Go watch that one before you watch this one. Which I think is a perfect time for me to answer the question, why would you want to invest into an income ETF that follows the Nasdaq-100 index? Because the Nasdaq-100 is a non-financial index filled with the 100 best stocks traded on the Nasdaq Stock Exchange. And it usually skews heavy with the tech giants, such as Nvidia, Apple, Microsoft, and Google. So it's one of the more popular indexes out there. And as a general rule of thumb, with the options strategy applied to the Nasdaq-100, there's usually higher volatility, which means the option premiums are going to be richer, and it's going to result in higher income payouts to you. Your dividends will be bigger pound for pound in comparison to their S&P 500 peers. So with all of that said, the first Nasdaq-100 income ETF that we're going to be taking a look at is the NEOS QQQI. And they debuted on the stock market in January of 2024. And for every single one of the following income ETFs that we're going to cover in this video, we're going to assume that we bought $100,000 worth on February the 13th. Why February of 2025? Because that's when the most recent income ETF was debuted on the stock market. So to keep things as fair as possible, we're going to use the exact same timeline for the past 6 months. And I love that we're doing February because I think it captures the April sell-off and the potential rebound. So you would get the highs and the lows baked in a 6-month time sample. So I like it. So having said that, if you bought $100,000 worth of QQQI at about 54 bucks, then you would have about 1,800 shares in your portfolio. And in the past 6 months, it paid out $6,700 in dividends. That's pretty darn good. Off of $100,000 invested into QQQI. Did I say QQQ or QQQ? Too many Qs. Triple QI? Dude, I think that's pretty good. And that initial $100,000 invested into them on February 13th, well, it would have transformed into $99,389, which means the capital preservation, I would argue, is pretty good. That's not bad at all. And so if you bake in the dividends paid out with their current portfolio valuation of $99,000, then the total return in your portfolio, taking into account the dividends as well, would be $106,000. Friends and family, I think that's pretty darn good. And the assets under management is just shy of $4 billion. That's a good size. And the distributions are mostly ROC. For me, that's a green flag and my preference. And the next one on the chopping block is going to be the Round Hill QDTE. Ticker symbol QDTE. QD. I like the sound of that ticker symbol. Anyways, they debuted in the stock market in March of 2024, and if we had bought $100,000 worth on that specific date of February 2025 at $40.32 a share, then in our portfolio, we would have about 2,480 shares of QDTE. And since then, in the trailing 6 months, it paid out about $15,000 in dividends. Dude, that's bonkers. However, on the flip side, your initial $100,000 would have turned into $88,000. So your capital would have shrunk by $12,000, even though the dividends paid out is $15,000. So I guess you would be in the green by $3,000. And that's why the current total return is $103,000. So you would still be in the green by about $3,000. And the distributions, the dividends that you receive are ROC, which for me is a green flag. And the AUM is $855 million. They're almost at that 1 billion territory, which will be a huge psychological hurdle and barrier they need to cross. Because once they hit 1 billion, don't quote me on this, but I think it's going to get bigger and bigger at a faster rate. And the next one is the Yield Max QD, ticker symbol QDTY. And they debuted in the stock market on February the 13th, which is when we're starting this experiment. And on that date, each share would have set you back by about $50.61. And if you bought $100,000 worth of QD on that date, then you would have about $1,975 in your portfolio. And since that time period, you would have received about $12,000 in dividends. And the distributions, by the way, they tend to be overwhelmingly ROC. It's usually like a 90%, 92%, with some ordinary dividends sprinkled in. And your current cost basis, that $100,000, would have shrank down to $88,895. So slightly better than the Round Hill flavor and variety, but yeah, capital preservation, not exactly happening. However, you would still, in the grand scheme of things, in the bigger picture, you would still be in the green because your current total return would be $101,000. However, what I do want to focus on and call out is that their AUM, assets under management, the valuation of their ETF is only $12 million. Friends and family, $12 million, that's basically a lemonade stand with the sign is the ticker symbol QD. That is tiny, which for me is a huge red flag. But we do need to be cognizant and mindful that they debuted about 6 months ago. So this ETF is still in diapers. Only time will tell whether or not their AUM is going to grow. But for the time being, I really don't like that. And the next one is going to be the JP Morgan Chase's JEPQ. This one's really popular. They debuted on the stock market in 2022, and in February of this year, each share was about $58, which means with $100,000 invested into JEPQ on that date, we would have about 1,720 shares as a result. And in the past 6 months, JEPQ paid out about $5,471 in dividends. And on the other side, your 100 grand would have transformed into $96,128. But when you bake in those dividends, you would still be in the green. Your current total return would be $101,599. But I do want to emphasize this and call it out. Those distributions, those dividends that you get from JEPQ every single month, well, it's going to be ordinary, which means you're going to be taxed at a higher rate. I'm not a fan of that. However, what I am a fan of is that their AUM, their assets under management, is just shy of $30 billion. That's a really fantastic thing to see, and that's basically the GDP of a very small country. You see what I'm saying? And something that I forgot to call out is that when it comes to the YieldMax QD and the Roundhill QDate, they both pay out their dividends and distributions every single week. Whereas with the NEO's QQQI and the JP Morgan Chase's JEPQ, it's every month. Moving right along, the next one is going to be the Goldman Sachs GPIQ. That's a tongue twister, GPIQ. Anyways, they debuted in the stock market in 2023, and in February, each share would have set you back about $50.42. If we bought $100,000 worth, then we would have about 1,983 shares in our portfolio. And in the trailing 6 months, they paid out about $4,900 in dividends. Dude, these numbers are freaking absurd and crazy. But anyways, their current cost basis, this is what I really like. Your initial 100 grand would have transformed into $101,000. So it's not just about preserving your capital and remaining flat, but they're also growing it as well. Dude, I think that's a huge green flag, and that's pretty impressive in my opinion. And the current total return with this number and baking in the dividends would be $106,000. Friends and family, I think this is pretty good. And it gets even better because their distribution, those dividends you get in your pocket, it's mostly ROC. And the assets under management is $1.3 billion. I think everything about the Goldman Sachs flavor and variety of the QQQ Income ETF, pretty respectable, right? Wouldn't you agree? And last but not least, we have the Global X QYLD. They debuted on the stock market in 2013. No, that's not a typo. They've been on the stock market for about 12 years, so there's a lot of data to work with. However, we're only going to be looking at from February of this year up until this point. $100,000 invested into them at $18.75 a share would have yielded us 5,333 shares of QYLD. Dude, that's absurd and insane. And because you hold so many shares, your dividends paid out would have been $6,180. I think that's pretty good. However, your initial 100 grand would have shrank to $89,000. Not too good. And it gets worse because your current total return, I think it's the worst performer out of this entire bunch. Taking into account that $89,000 of your capital in your portfolio plus the dividends paid out would be $95,000. So out of this entire list, the only one where you would have lost money would have been with QYLD. So that's why it really bothers me and it puzzles my mind as to why the Global X QYLD is so popular. And I say that because their AUM is $8.3 billion. So it's popular. There's a lot of people that have their money invested into them, but it doesn't really make sense to me, to my small, smooth brain. The ROI is just, it's not there. However, I will give it to them. At $8.3 billion, they are the second biggest ETF on this list. So that is a positive. And another positive is that your income distribution that you get from QYLD, it's ROC. So that's good. However, the consequences and the results by investing into them, it's like you're down by -5 grand. Whereas with most of these, you would be in the green by like $1,000, or even with the QQQI, you would be in the green by 6 grand. And of course, with the Goldman Sachs GPIQ, you would also be in the green by 6 grand. So, but having said all of that, if all I cared about were the dividend distributions in the now, with a short-term focus, disregarding my capital, I don't care how much my portfolio is valued at, I only care about the dividends pouring in, then I think my top pick would be the Roundhill's QDate, because the dividend distributions in the past 6 months, yeah, it's $15,000. That's a pretty picture. And I think in second place, it would be the YieldMax's QD. $12,159 in dividends. Yeah, they take the cake. However, if I were to apply my metrics and the criteria that we covered here today, then I think by far the best one objectively would be the NEOS QQQI, and the second place would be the Goldman Sachs GPIQ. Because with both of those, your money would be $106,000. However, something that you want to know about me is that I'm a long-term investor kind of guy. Like when I buy into a stock, my horizon, my timeline is not 3 months or 6 months. I try to look at things for the next 10, 20, 30 years. So on paper, even though the NEOS QQQI did outperform the Goldman Sachs GPIQ by a little bit, I think the brand reliability and ultimately the team that's running the GPIQ, those two factors alone are enough for me, for personal reasons, to put the GPIQ ahead. Yes, I know that's controversial. So if I had to invest into a Nasdaq-100 income ETF, I would personally go with the Goldman Sachs GPIQ. And mind you, I'm not investing into any one of them. So I'm saying this without any bias or an hidden agenda. So I would go with the Goldman Sachs GPIQ. Close second would be the NEOS QQQI. Because I love the idea of my capital not just being preserved, but it's growing as well. And I know that's something that we don't care about, but as a younger guy that's in his mid-30s, it matters for me. I don't want my portfolio to just remain flat at 100 grand of that initial that we invested into back in February. I would love to see it growing slightly, even if it's at a very sluggish and a slow pace, to still be growing. I'm a fan of it. However, the facts don't lie. The dividends paid out, $4,900 in comparison to the $6,700. All that to say, I don't think you could go wrong with either one. I think the only one that I would have an issue and a problem with is the Global X QYLD. And I know I stepped on some people's toes because whenever I talk negative or trash about any investment on this channel, I always get angry comments from folks because I understand. If someone were to talk smack to me about McDonald's or Chipotle or even United Health Group, which are companies that I am invested into, it's not a good feeling. So I understand, but I think based on the facts and the data and the numbers, the QYLD is the only one that makes me hesitate. Does that sound better rather than saying I hate and saying that I have a problem with? I think hesitate would be the more palatable and more kind way to say it. So what do you think? Those are the results. Are you invested into any of them? Which ones are you potentially eyeballing? And if you're enjoying these videos and you want to keep this thing growing, this YouTube channel, then please consider joining the Patreon. Because on the Patreon, there's exclusive content up there that never makes its way over to YouTube. There's no pressure, but every little bit really does help. Anyways, I hope you guys enjoyed this series. And as a friendly reminder, if you haven't watched the S&P 500 Income ETF version, go watch that one, part 1. Other than that, I hope you guys have a good rest of your day. Stay safe, good luck in the stock market, and I will talk to you next time. Peace.